Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Thursday, May 14th, 2020. We'll do is start out a quick look at the broad markets and then hit on a few different things. We'll kind of look at some trade ideas, official and unofficial, commodities, things like that. All right, so starting out with the broad markets, bigger picture, and I think this is important. I try to do my best, especially during these videos, to convey my thoughts and differentiate short-term outlook for the market, meaning short-term meaning hours sometimes, and depending on how short a term, hours or just maybe days. Intermediate term, which is typically weeks, several weeks, a couple weeks, a week, 2, 3, 4 weeks or more, and then longer term, which is usually measured in months or even years. In those terms, those time frames are typically commensurate. These time frames are all related together, the same security. But when I'm talking about a monthly time frame, anything that's going on there, obviously that's long-term stuff, and nothing changes on the monthly chart till the end of the month, at least not officially, I should say. You get the final candlestick, and so bigger picture here in the S&P 500 is it's been back testing that key 20-month moving average, which does a great job of identifying bull and bear trends, bull and bear markets, and has for decades now. We've gone over quite a bit, so we're not going to do that in this video. And we're also back testing the lowest most or the primary bull market uptrend line from below. So that's all bearish, until unless they can close on a solid monthly basis well above and put these levels, the 20-month EMA and the trend line in the rearview mirror. So nothing's changed on my longer term outlook. But again, wait till the end of the month, and then if we don't have any, definitive resolution, maybe we close right on these trend lines in the 20-month, then we have to see what happens at the end of June. So, active traders, it's going to do you no good here. This is kind of long-term stuff, paint the bigger picture of where we might be heading months from now, maybe even years from now, depending on what happens here. As of now, it's a breakdown, which is a sell signal, and two back tests, failure to recover that level, back testing from below. And as I maintain, still means anywhere in here, especially longer term view, offers an objective short entry or an objective time to exit your longs following those sell signals. If you held on, you got a nice kickback rally, and that's it. Now, if we get back up there and you sold your longs, you could always go back in longs. You could cover your shorts. Again, long-term stuff. So let's go back down here to, well, there's the weekly chart. We could take it all the way to the daily chart. Let's just start right there. All right, on the daily chart, the most significant levels here, we'll zoom in, are again the 61.8 Fibonacci retracement level. That's of the entire initial bear market drop into the March 23rd lows off the February highs. Failed there, as well as that key 200-day moving average. So again, everything I've covered lately. Then we had the other day, after several failed attempts to get through that level, we had a bearish engulfing candlestick on SPY. I said that's a potential reversal stick, or at least marks, usually at the very least a tradable correction pullback. And I said what you want to see ideally is follow through with red candles the next day. And like I said, the redder the better. So we had some pretty big red candles yesterday, closed well below that in both SPY and QQQ. So that's that. There's the bearish engulfing candle on SPY. There's a QQQ. There's the follow through. You can see we're at support right here. So that's the story. Nothing goes straight down forever. Just because you have a sell signal doesn't mean, even if it marks a major top, let's say the end of the bear market rally, which I think is very possible, doesn't mean we go like this. More so, you go something like this. And who knows, it could be pretty quick, or it could be more of a grind fest like we had on the way up here recently. So let's just look at levels. Let's zoom down all the way to the 60-minute charts to see what's happened there. QQQ dip below that. We have dual gap former resistance. Well, it's now or support. Remember, when prices are above a level like that, it acts as support, and when they're below it, it's resistance. Now we chop through there, a little bit choppy, and again we have those 60-minute divergences on the indexes playing out, and a couple other things here to note. I want to just point out that we entered the gap from below, almost backfilled it. In other words, this is the bottom of the most recent gap, and it's right around the bottom of that other gap right here. You can see, let me just make sure you can see this on the video. There's gap 1, gap 2. So we made a near backfill, but we reversed, and right now we're back above that level 217. Now, we've traded through it quite a bit. Like I said, prices can, or you can have a reaction in one of two ways. A bounce off a level, or we can correct in time, and that's also a reaction. When you're falling straight and then you stop, that's a reaction. It's like, let's say you take a rock and you drop it onto the sand. It's not going to bounce. It's going to stop and hit the sand. That's a reaction. It's not falling anymore. It was in motion there. Or you can take a golf ball and drop it on a concrete floor. Same thing, except it's going to bounce. Either one of those, I define a reaction as a bounce and or a consolidation, and that's what we had so far, and we're still having, actually. That's what's going on here. So at the end of the day, we're consolidating here. There are some potential bullish developments on the near term that we can watch for, but again, what I just started with, long term bearish, especially on those daily charts. The fact we have those confirming sell signals after the bullish engulfing candles. So make no mistake about it. Somebody asked today, they said, "Oh, Randy said now we should cover and go long," and I didn't say anything remotely close to that. I try to differentiate what short-term bounces, like we had a short-term bounce yesterday for active traders that might want to game that, and we had a short-term bounce yesterday as well. But long term, whether we bounce a little more or not, it appears that we are going lower from where we topped out the other day. That's, at least as of now, my take on the market, and if it changes, I'll let you know. All right, so there's QQQ again, kind of a little whippy, halfway entered, or maybe 2/3 of the gap, but back above that 217-ish level and really into this area here. So it's nothing clear, at least on this chart. One more thing I will point out, something that is worth noting, and it's a potential bullish development or potential bearish, depends how it plays out. When I say, I highlight sometimes key levels to watch, and I also highlight what I call potential developments. Potential means something that may or may not happen, such as a wedge break, sell signal come on a wedge breakdown. That's a potential development. We watch, it doesn't happen, you hold the trend line, then you break down, boom, there you have the development, you have the sell signal. Now, potential development to watch right now would be this purple line. I usually use the 0 line to delineate bullish and bearish trends on the PPO, which is down here. It's a momentum indicator. And I like to use the 9 EMA, the signal line. It's the last of the two to cross. That's why. So if you use that, it tends to help filter out whipsaw signals. Now, every security is different. So on QQQ, I've noticed that that 0 line tends to give you the buy and sell signals when it crosses right here, this purple line, which is just a hair below. It's a value of negative 0.34 instead of the 0 line. And as you can see here, you got there, boom, across below. Said trend was bearish right there, and it was, and it told you this whole time when that white line was below. Even it back tested there and was rejected, and then boom, gave you a buy signal there. So it said sell signal, cross bullish here, had a back test, slight whipsaw. I'm going to call that a whipsaw, but it went right back above. So I'm going to say this whole time here, from here to, well, still right now. That's why it's a potential development, still bullish. It's telling you this has been a bullish trend and still is by that one trend indicator. So you have the cross currents, you have the divergences that I've talked about. But as far as a trend goes, and we can take away every line on this chart, which I'll do here in a second, I just want to say I'm watching that. Well, because again, the potential development is either bullish would be a successful defense of this, and that is, there's a decent chance for that, because I'm going to get to those futures charts. Again, those bullish divergences are still intact. Positive divergences, which are bullish. And that would be bearish to see a solid breakdown below there, signaling we're in a new downtrend. But that's just one of many trend indicators. What a trend is, plain and simply, the definition of an uptrend is the security making a series of higher lows, which we have here as I'm marking, and a series of higher highs. So right now, QQQ is in an uptrend. Now, QQQ is not the market. I'm going to get to that in a second. SPY is more of the market, the stock market. This is really just a tech index, if you will, or tech-heavy index, not pure tech, but mostly tech. And that's that. So the potential developments to watch on QQQ would be a breakdown below this previous reaction low right here. If that happens, we'll also most likely have that crossover there. So that's what we need to watch for on QQQ for more of a intermediate term sell signal, not this very near term stuff I'm talking about. On SPY, The uptrend has been called into question, and again, SPY is more representative of the stock market, or you can use DIA, the Dow Industrial Tracking ETF. But you're going to see those two are going to look more similar because they don't have the they're not as concentrated in technology, even though it is the highest component. It's not nearly what it is in the Nasdaq 100. So SPY was making a series of higher highs, higher lows and higher highs, as you can see here. So it wasn't an uptrend. All of a sudden, something's changed. This recent high, not by much, but it was slightly below this previous high, and now we've undercut this previous reaction low, not by a lot, but we've undercut it. So technically speaking, and I'll say it's a bit too early to say, well, we're definitely in a downtrend, but we do have the potential makings of an early downtrend or a price channel. That channel may change, but again, the point being that you have these lower highs now, and as of today, a lower low. So by that metric, we can say that, hey, the uptrend in SPY may be over. We may be on the new downtrend. And based on everything I just showed you on the daily chart, I think that's the case. Okay, so to make it very clear, like I tried to do to that question on the homepage, it was from yesterday's post. Nothing's changed, and the only thing that's changed recently is the SPY trade looks even better now than it did a few days ago because of what happened on those daily charts with the rejection off the 61.8 fib, the rejection off the 200-day moving average, the bearish engulfing candlestick on Tuesday, and then the follow-through confirmation with another red candle yesterday. So if nothing else, we received several check marks for the SPY trade the other day. All right, and now again, like I said, by these trend indicators here, we received a couple more on this 60-minute chart, and then finally, like I said, I like to use that zero line, or on SPY we can put a level a little below. I might have done that. No, let me do it now. Let me show you here. Let's just put a line just below. I mean, it's so close, but we'll do that. So you either have, let me pull this back up. You have the zero line right there, which usually defines the trends. Things have been a little whippy lately, or you can give it the benefit of the doubt, put it right about here. Okay, if we put that line right there and we focus on the white line, you can see back here it crossed, giving a sell signal, or at least confirming a trend change, kept you there to right here, bullish. And then from there, that line acted as support when backtest or near backtest. And we're starting to crack below it now. So again, we are below it. The farther we go, the greater chances are that that's a solid sell signal won't prove to be a whipsaw signal. So there's another check mark. Put a small check mark now if we continue down a little bit bigger. So there's enough evidence I just showed you on the daily and well, start out on the monthly, but more so on the daily and 60-minute charts that we may have seen the highs or the end of the bear market rally in SPY, which is what I'm going off of right now, and continue to maintain these targets. We sidestepped this, pulled our stop quite a bit here because again, nothing happened. We flattened out, went in that trading range, and again, that's the other thing I want to bring up too is bigger picture is that you take everything away, all the trend lines, and you just look, we've been, the bulk of the big sharp move was from here to here, then we had another strong leg from here to here, and then from that point we kind of chopped around sideways for the last over a month now, and so really it's about right here at the bottom. We need to take that out to really seal the deal, or kind of put the nail in the coffin to say, yeah, you know what, the uptrend is now over, because we're going on and we're making now a series of lower highs. So that hasn't yet, and of course also taken out that price support there at the bottom of that trading range. So those are the things I'm looking for. Right there, the divergences, tell me we'll probably get that, but in the near term, nothing goes straight up or straight down, at least not forever. And so we're going to flip to the futures real quick. This is what we have to keep an eye on. These are, pretty decent divergences. I mentioned they were in place yesterday, and I said yesterday if we went any lower, and again today we have support down below, and there it is, that 88.31-ish level on NQ. That was effectively hit or close enough, and said if we did that today, which we have now, that would only extend these divergences. In other words, keep the bullish divergences intact, make them even larger, and it does set the stage for potential rally. On the flip side, I gave you quite a bit of bearish evidence a minute ago, and like I like to say, fewer things in trading and investing are more bearish than a failed bullish breakout or failed bullish technicals that fail to materialize. In other words, this should, by most metrics, result in a nice tradable trend reversal that could take us all the way back up here. Heck, if this market's going to new highs, or if we're going to take out the other highs, this would most likely be the catalyst to do so. So right now the onus is on the bulls. Let's just say it that way. To take this and run, to take these divergences, keep them intact, even if we have to dip down once more, as long as we don't take out the previous lows there. We have those divergences. This is what for the bullish case should happen right now. If it doesn't happen, that's going to be pretty darn bearish, and I think you'll probably see a pretty quick slide once the bulls realize, or long side traders, I'm speaking metaphorically, of course, to those that are looking for these things. Once the bulls realize that that has not been the case, and that this pullback here, which was the biggest drop that we've had in for a while, about on par, maybe right around this one here, that was not a buying opportunity up until now. And that's what you get when you're in an uptrend, near-term uptrend. It's called recency bias. Traders, believe that things will continue, and that's what trend traders are all about. When you recognize a trend, I'm not trying to do an uptrend here. You're in an uptrend, and you buy the dips and sell the rips, or just buy the dips, continue to add to it. And so when we look at NQ, this is a very busy chart. Apologize for that. I'm going to get to ES in a second. Same thing, the near-term trend off the lows in March, or intermediate term, more accurate. And intermediate term is bullish. You can see I'm just marking these series of higher lows right there, and of course the higher highs. They're all divergent highs, but or at least the ones I'm circling. There were other highs there in the series. So there's your uptrend right now in NQ, but again, NQ is not the stock market. ES and S&P 500 and SPY, they're more indicative of the overall stock market. And ES, just like SPY, made a new low today. The bearish case would be I'd be a lot more confident right now that we're going to go lower if we didn't have the same thing. We have those negative divergences in place. Let me just zoom back down, tighten this up to 1 month time frame. We were looking at 2 months there. That's it. So you have these pretty clear and pretty solid positive divergences, and that's a big part of my trading, especially when we're still within that multi-week, month plus trading range, and so we could certainly bounce here. And if we do, levels that to target or note if they're taken out. We have that trading range yesterday. Remember, we hit, this is about where the SPY and QQQ fell to support, and as I mentioned, we traded around all day yesterday, all night, and then had a little brief pop this morning, but we've recovered a lot of that drop. But we're coming back right now as I do this video. See, we're just below the the bottom of that recent trading range. That's resistance, because we traded in there so often, or so long, and I had it at about 2,800 as support anyways, and support once broken becomes resistance. So here's where we're at, and then we'll move on to some other things. This is what needs to happen to help firm up the bullish case. We need to take that out. Of course, the bottom range there, we'll call it 2,800, and especially the top of that range. If they can do so, that would be bullish. It will keep these divergences intact. It could be the catalyst for a rally. If you think the market's going to new highs, I don't know why you wouldn't be stepping in here and buying at support with divergences. But even if you think we're going lower, as I do, I can still, try to game these quick, counter trend bounces. We have plenty of upside to go to keep what could be, again, a new downtrend. Remember, this is the ES right here, the S&P 500. You can see we're making lower highs so far, and we're also, as of today, making lower lows. So, I mean, look, technically, to just keep a nice clean price channel, we can come all the way up here and just undercut. If we fall shy of these previous highs right there in reverse, that's just the making of an early new downtrend channel. It wouldn't be a very steep one, but it would be about in line with the uptrend rising price channel that we just ended on. So I just want to say that there's a lot of lines, and I'm probably making your head spin where we can go, but again, these are the developments to watch for. If we just turn around at some point today and the market takes another dive down, we undercut all these, burn through the divergences, that's going to be pretty darn bearish there. And again, if I had to just, and I made it clear yesterday too, my swing positions are still short. I'm in and out with futures. I was in and out, even out since the last video last night. Booked some profits. I decided to reverse back short later in the evening. Covered. I'm in and out, in and out. That's active trading stuff. But as far as swing trading, I'm sitting tight. I think there is more downside for the case that I presented on the longer term charts and daily and everything else here. But recognize we could bounce in the near term. And we might not. And if we don't, that's even all the more bearish, if you will, if these divergences fail to play out. So that's that. I think I already gave you that on NQ, same story. We were zoomed out a little on NQ. Let me go back here and just point out that the divergences are intact. And we can even take another thrust down today and they'd still be intact. Divergences are not the be all end all. It's not a guarantee of a rally, but while they're there, you need to be aware that they could be the catalyst for a rally. And we've got plenty of upside to go before NQ makes a new high. So if it fails to make a new high, so far right here, 1, 2, 3, we have a series of lower highs right now and a series of lower lows. So in the very near term trend, shortest term trend right now is bearish. Intermediate is bullish off the March 23rd lows, and then the longer term trend is still bearish because we're well off the stock market highs. And again, more importantly, the S&P 500 and Dow and small caps, mid caps are well off their highs. When I talk about it, because if you said, well, Randy, NQ is getting pretty darn close, the Qs are close. Remember, that's not the stock market. You're looking at just one sector that has been a beneficiary, mostly technology stocks since the whole COVID thing. And they will not, and that's how the last bear market ended, or bull market back in 2000, or the previous one back in 2007. Remember, very clear at the end of the rally, it was just a handful of those big fang, tech heavy stocks, market leaders that were doing most of the heavy lifting, while the internals were deteriorating, meaning fewer and fewer stocks were making new highs, and then finally the top was in. So it's not unusual when there's a correction, especially the first correction of bear market. You get all those people that got shaken out of their Apple and their Amazon and their Facebook. They go back in. You have all those people that for years wanted in and just never pulled the trigger, wanted a buying opportunity. They jump in, and that's the whole nature of a bear market rally, or a correction within a larger downtrend. Or even if the market's going to new highs, that's what people do. They usually jump on, and they've been doing that lately. They perceive those stocks as safe haven stocks, but as I talked about before, and as we saw in the last plunge, we saw in the fourth quarter, the big meltdown in 2018 in the fourth quarter, what happens is, as great as those companies are, and I cannot knock them from a business perspective. Apple is a earnings juggernaut. Amazon, Facebook, they all are. However, their downfall is what brings them up in a rising market, because they're top components of those indexes. So when money flows, every dollar you put in your 401k that's going into your S&P 500 index fund or your large cap growth fund, it doesn't matter. They all are top heavy in Amazon, Apple, Facebook, Microsoft. So it works great, lifts them in a rising market. When money flows start going the other way, you pull money out, investors are pulling money out, pension funds are selling to protect from losses. It happens in reverse. No matter how much money Apple is making, or Facebook or Amazon, no matter how promising their outlook is, it doesn't matter, because they come under forced selling pressure. So that's why you see those big drops like we did just a few months ago in those big names. And of course, they got pretty darn beat up and oversold, so they snap back. Okay, trade ideas. Let's look at some commodities and some other things. Yesterday, remember Brandon Lang had brought out UGAS, which is the natural gas. That's the 3-time, might have reduced to 2-time leverage, or it may still be 3-time bullish nat gas ETN. I like to, even if I'm trading UGAS, I typically trade NG, the futures, but I'll trade UGAS sometimes as well. And it will do a decent job of tracking, but not perfect NG. So I like to use NG as natural gas futures as chart. And I said, look, it's testing. Yeah, it's testing the early April lows. So a case can be made for a pot shot long entry here with a stop somewhat below. Although I can't make a strong case. We didn't have divergences, everything else. But I kept it on my radar and I watched it today. And then I did see an opportunity and I posted it in the trading room today. This is more than 2 hours ago. I haven't refreshed this. But it was 10:12 this morning. And said, look, here we go. Potential targets for nat gas with objective long entries off these. That's where we were yesterday when I talked about, when I mentioned it was testing its previous low, and that was the objective entry right there. That was the previous major reaction low, and that's traders will look at those. That's where we were yesterday. So so you go there, you could put a stop a little bit below. We'd already dipped below it at that point, so you'd probably have a stop a little below there, or even tighter. And so far so good. Basically, I give you 2 price targets in the trading room, and you could either buy it, close to this 16, any pullbacks to that 162 level, and still can, or break out above the 166 level. And that did happen shortly afterwards. We went ahead, and as I posted it, we broke out. Boom, there it was. Big impulsive breakout. You can see right over the 166 level, and that opens the door for those targets. So it's still, I'm highlighting it because it's an unofficial trade. Nat gas is a volatile little sucker. If you trade it, you know that. So far, the breakout has held. And so that again increases the odds. We'll continue on up here and hit at least that target, and potentially this one here. And at this point, if you bought it on a breakout above 166, you want to have a stop a little bit below that, not too far, somewhat below, maybe in the midpoint there. And or sometimes it'll help to use your stop on a closing 60-minute candle basis, because nat gas is whippy, can come on down, run the stops, and pop right back up. So if you use a 60-minute close, it minimizes the chance you're going to get cleared out in a stop rate. Whippy pullback. So there's one trade idea. And I gave somebody asked about in the trading room as well, UNG targets, and I gave those right here. This is what UNG looks like, and we're already at the first target. First right there, 1175. Hit that. Next target's there about 1220, then 1250. Possibly, if we get some traction, 1288. A little bullish PPO crossover there, and it will be bullish if UNG can recover these levels there, especially if it can pop above that 1175 level with conviction. So there's one potential trade idea. Could probably add a trend line, but I don't want to force anything here because I tried doing nat gas futures. There's somewhat of a trend line. It's just, especially on the futures, it's not very well defined. But either way, you have a confluence of resistance. That potential trend line right there and the 1175 level, solid pop should open the door there. Otherwise, you get rejected. You don't want to hold nat gas too long. If it goes much lower, especially if it takes out the recent lows, that's going to be a bearish technical event. So there's one idea for you. And another commodity / precious metal, gold. This is GC gold futures. The other day, what was that? The 11th. Today is the 14th, so that was Monday. We had here, I pointed out, we had this breakout to kind of recap what's happened in gold, breakout of the symmetrical triangle pattern, which was bullish. And then I mentioned here as we're going up, that it would put in the small divergent high, and that could lead for a correction and to back here. And if I said if that level is taken out, then that'll probably open the door for a back test. So when we did back test, I did say that was an objective long entry, offering another objective long entry for the next leg up. And that was again Monday. Let's look at today, and I'll get to gold future, gold the ETF in a second as well. GC right here. So we're good so far for about a 3.2% rally in gold futures, which is a nice move if you trade futures. It's not huge if you're trading GLD, but so far so good, because we did exactly that. We number one was the breakout, probably the most significant thing of this symmetrical or near symmetrical triangle pattern. Impulsive breakout, went up quite a bit, got near-term overbought, put in that divergent high there, made a almost perfect back test, and then rallied up, and it's taken out that previous high now. So that's good for gold. probably an uptrend we can start to watch here if you're long, maybe objective long entries on a pullback to 1728 support, and or that trend line would be your next objective entries. And this is still the next target up there, about 1759, excuse me. If you trade, if you don't trade futures, I get it. There are micro contracts for GC. I think it's MG. No, is it MGC? Q. I have to look it up. But a lot of the futures that I cover, like natural gas, for example, I mentioned that in the trading room, has a mini contract called QG, and it trades all these mini contracts, whether it's the S&P 500 futures, Nasdaq, gold, natural gas, crude oil. The minis trade at the same exact price levels as the bigger contracts. So if you want, if you're dabbling in futures, but they're a little too leveraged, a little too big of a position size for your taste, you can use those minis, and you can use the same charts that I post for the regular futures. So here's GLD, and that's the same thing. Really, it's going to track. It does almost a perfect job of tracking gold futures. And same thing. We had your symmetrical triangle pattern right there on the 60-minute chart. Breakout, back test just like the futures, and rallied up, and we're at this resistance level now. It's around these previous reaction highs here and here. So gold's at resistance. If it can pop that, bullish, and I remain longer term bullish, and I think that's the most likely route for gold. We'll have to watch it, because any new high over that previous divergent high there will still be a divergent high unless we can take it out here. Maybe we take out the divergence on the RSI, but like I said, as of now, I think it looks good. But now's not the time to buy it. I just showed you that. Maybe on a pullback to one of the support levels on GLD, pull back here at about 160.110. We can do a comparable uptrend line like I did on GC. That may also provide objective entries, and also an area if you wonder where to put your stops. Look for these reaction highs. That's a level that should contain pullbacks, and then that uptrend line right there. So doesn't mean gold can't or won't go up, so you could add to it here, but the most objective entry again is a pullback to support, especially after a nice thrust up like this. And speaking of things pulling back to support, a member in the trading room mentioned the nice drop in Costco today. Costco is one of our active short trades. So far, so good on that. I mentioned, yeah, great, thanks for pointing it out, but I said it is coming up. I said it wouldn't be objective, in my opinion, right now. At least I was earlier today. We were right about here. I said we're coming right up on the 294.17 support plus uptrend line support. You can see this trend line here. I know this is a busy chart. Let me just show you the levels that stand out to me right now. We have this trend line off the the December 2018 lows right there, and price support at about 294 or so, a little bit above 294, plus some key moving averages. So I do think over time it goes, and it could go sooner than later if the market drops, especially. Here's what it looks like on the weekly chart. This is where this trade is based off of. We entered up here somewhere. I can't see. My entry price was 301.55, so we're profitable on the trade, not by a lot. It's hardly, virtually flat. But again, you can see that trend line. First target's down here, 282.20, and then these additional targets. Again, this is a long-term trade. This is a bear market trade for me, trend trade. I'm trying to capture the, a bigger move and not just a quick in and out swing trade. But trade it as you like. Like I said, we're coming up on support there. So Costco, and another one too is Verizon. That's also based off the weekly chart. We shorted Verizon up here on the back test. Big impulsive drop today, but right down to this support here, 54.36. That is a pretty important support level. I think it'll go, but I just want to point that out if you are short Verizon. We have reactions here. Yeah, actually, I had to look like a little head and kind of a head and shoulders. Here. Quite a few reactions along this level. We shot below there with that kind of V, drop, but it is still an important level, I believe. And so once 54.36, or we'll call it $54 to be safe, goes with conviction, that should open the door to a drop to a T1. It'll certainly help if the market falls as well. A rising market is a headwind, if you will, for a short trade on Verizon, because it is a component of the S&P 500. As is Berkshire, of course. Yeah, I know what, I'll probably do the commodities in a separate video, and that way I can keep it strictly on commodities. I want to cover a lot of the agricultural commodities. I'll touch on crude oil. I already hit natural gas on this one. but I'll keep the next video or coverage, whether it's individual charts on commodities. TVIX, okay, the TVIX is an active trade, an official trade. It's up, pretty handsomely. I forget exactly where we entered that one. I know we got in a little bit early, but then, like I said, patience pays, and that's why I like to get in. Sometimes when these things move, they move fast, and so if you weren't in it before the big run up, you may not have wanted to chase it. I mentioned quite a bit early on in this trade that not knowing where if we'd get to this downtrend line first or my 247.94 target, but I did say there's a trend line that is likely to come into play, and that was hit today. So we hit that trend line. I've maintained these targets, but I just want to mention, as I did before, that was an objective level to book profits, partial or full, if you just wanted to get the quick rip out of TVIX. But ultimately, I think we come on up here and go on to hit these targets, especially if the intermediate to longer term bearish outlook on the stock market that I started the video out with continues to play out. So to me, it's mostly a matter of, there are no guarantees, of course, but it's more of a matter of, do we do this? We already had a reaction off that level. In fact, that's what I always say is it's the initial tag of a resistance level from below. When you're rallying up to it, that you usually get a reaction. So there's your reaction. Now, whether we have more of a reaction, or whether it's in time or price or not, it doesn't matter. We've already had that reaction. So now the next test of that level will probably break out that trend line, and then that opens a door for a move up there. That 290 or 247.94 is set at horizontal support right there. And then 296.80 and change. The resistance is really around 300 or so, and then 400 ultimately. And again, this will almost certainly take the market going down and SPY hitting at least the first price target, if not more, to get us up here on the VIX. So I just want to point that out, that this trade and the SPY trade, as well as a lot of our other index components such as Berkshire and Verizon and those, they're concentrated trades, if you will. You are diversified by having different positions, but I'm either going to be right on SPY going down and right on TVIX going up, or I'll most likely be wrong on both. So just keep that in mind in your positioning, and that's why I like to trade. That's why I have gold and treasury bonds and other things in my portfolio, because they don't have they have a pretty low correlation, and I can be wrong on my index shorts but still right on gold, for example, and that's the benefits of diversification. Speaking of treasury bonds, I mentioned UB. This is the longest term, the 30-year treasury bond futures. I mentioned this trend line here the other day, hitting that. We bounced off it, and I said there was a little triangle pattern here. We made another test of the trend line, finally broke out. So that's bullish for treasuries, which tends to be bearish for the stock market, because treasuries are a risk-off asset, meaning institutions start going into treasuries when they suspect the market's going to go down. And you have also ZB. ZB is also the long. It's I think the range is on UB, the Ultra Bond. I think it's something like 25 or 27 to 30-year bonds in there. And then ZB is a little bit shorter. They're still long-term bonds, but it's maybe like 22 or 25 years, something like that. So these are also long-term bonds here, and you can see we're above trend and slightly taking out this trend line, but the big level right here on ZB is 183.85, and these guys will mirror TLT. Both, if you combine ZB and UB, that's pretty much what TLT is holding. TLT is holding 20 to 30-year bonds, government treasury bonds, and we look at that. And you can see here, we're seeing this uptick in treasuries lately, which coincides with the drop in the stock market. So, and we had a little, just like there, we had a little trend line right there that was taken out. So I don't like the risk reward on treasuries enough to add it for a long-term trade. Futures are nice because if you trade ZB or UB, it doesn't take much of a move to put, several hundred or several $1,000s in your pocket because they're leveraged. But as far as TLT goes, the risk reward is just, it's like the stock market. It's not that attractive. There's not a lot of upside potential. It's not worth it. Maybe 3-4% potential, if that, 5 at max, compared to the downside. So it's like the stock market where I see minimal upside, gain potential in the stock market compared to the potential downside risk at this point in time. That's what I talk about risk reward. So you're not going to see TLT added as an official trade idea anytime soon, but I did mention that UB and ZB recently for those of you that trade futures. All right, let's wrap it up here, and we'll see how today ends. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.